Welcome back to the Wall Street Podcast. Today we're initiating a deep dive into the latest edition of the Wall Street Journal. This one published Wednesday, July 23, 2025.
Yes, and it's packed with analysis on, well, quite a few critical shifts. We're talking global economics, markets, geopolitical developments.
Right. Our goal here is to pull out the most relevant data, the key viewpoints impacting the world you operate in.
We'll try to summarize quickly, break down the main sections, focusing on the big research points, the market movers.
Exactly. Things like tech investment, national energy strategies, global trade dynamics, regulatory challenges, aiming for relevance, actionable understanding.
Okay, let's jump right in. First up, the AI race is heating up.
Definitely. The report highlights Elon Musk's XAI. Some pretty ambitious financial moves happening there. You could call it an escalating AI arms race.
And it's not just code, it's about the hardware, the infrastructure, big money.
So what's the specific play here?
Well, XAI is working with Valor Equity Partners. They're aiming to raise, get this, as much as $12 billion.
$12 billion. Wow. For what exactly?
It's earmarked for a new data center. They're calling it Colossus 2.
Colossus 2, okay.
Yeah, it's basically to power the training for its Grok chatbot. Think of it as Grok's brain, essentially.
And the funding structure. I heard something about debt.
That's right. Very interesting. They recently secured $5 billion in debt financing and the collateral, Grok's intellectual property.
Pledging the IP itself. What kind of yield are we talking?
A hefty one. The bonds carry a 12.5% yield.
12.5%. For an AI company with no real revenue yet. That says something about the risk appetite, doesn't it?
It really does. It suggests maybe that traditional equity investors are a bit hesitant, pushing them towards riskier debt. Or maybe the lenders just demand a huge premium.
Right. Betting on a future that's still pretty far off profitability.
Exactly. And the projections shared with creditors. They show XAI burning through about $13 billion in cash just in 2025.
$13 billion burn rate. Without profit, without significant revenue.
Correct. But you also have figures like NVIDIA's CEO Jensen Huang publicly praising Musk's engineering and resource management. He noted XAI is targeting 1 million chips for Grok.
1 million chips.
Yeah.
So it's an aggressive push, reflects the intense competition the capital needed.
Absolutely. Building proprietary infrastructure is key, but incredibly expensive. For you as an investor, it means really scrutinizing those balance sheets, those capital structures in AI.
That kind of capital burn isn't just in tech, though. The report pivots quite significantly to China's energy strategy.
Yes, a major effort to reshape their energy profile, moving away from oil dependency.
And the driver isn't just environmental, is it? There's a geopolitical angle.
A critical one. Chinese officials see national oil consumption peaking around 2027. It's driven by a government campaign to cut reliance on foreign oil.
Why the urgency?
Concerns over potential supply disruptions, particularly from the U.S. and its allies, maybe affecting key sea lanes like the Strait of Malacca. It's a national security issue for them.
So it's about strategic autonomy as much as anything else.
Precisely. And they're pouring hundreds of billions into two main areas. First, EVs, building the world's leading electric vehicle industry.
How are they doing that?
Well, over $100 billion in sales tax exemptions since 2018. More than 14 million charging points by May this year. That's 9 times what they had end of 2020.
Impressive infrastructure build-out.
And battery tech, too.
Yep.
Companies like CATL, BYD, they're enabling things like 5-minute charging.
Okay, so EVs are one pillar. What's the second?
Reviving domestic oil production, trying to boost their own supply.
Interesting counterpoint to the EV push.
State-owned PetroChina is drilling deep in the Tarim Basin. CNOOC is accelerating offshore drilling in Bohai, South China Seas.
And is it working? Are they getting more oil?
Yeah, output is up about 13% between 2018 and 2024.
So what's the net effect globally if China uses less foreign oil?
The IEA, the International Energy Agency, has already cut its forecast for Chinese demand. For the 2028-30 period, they've lowered it by over 1 million barrels a day.
1 million barrels. That's significant.
It really is. It could reshape global energy markets. For you, it signals potential shifts in oil prices, valuations in the energy sector. Big changes.
Okay, let's shift gears again. Global trade. The report describes the Trump administration's policies as, well, a complex mix. Tariff threats, bilateral deals.
That's a good way to put it. It's definitely dynamic, often unpredictable for companies.
How are they using these tariff threats?
actively leveraging them, it seems, to advance U.S. tech interests, trying to stop foreign countries from hitting U.S. internet firms with new taxes, new regulations.
And is that working?
We've seen examples. India withdrew its digital services tax. Canada rescinded a similar levy. Seems like a direct response to U.S. pressure.
So tariffs aren't just about goods anymore. They're a tool in the digital economy fight.
Exactly, shaping the global digital landscape. At the same time, though, new trade pacts are being announced.
Like what?
U.S. and Japan, for instance, agreed to lower auto tariffs to 15%, down from 25%, and cooperate on LNG exports.
Okay. Any others?
Separate deals with the Philippines and Indonesia. These set reciprocal 19% tariffs on imports coming in. But here's the key part.
Yes.
The U.S. gets 0 tariffs on its exports going to them. Plus, Indonesia is reducing non-tariff barriers on UN goods. Gives U.S. exporters an edge there.
But these policies, they have consequences for companies.
Well, absolutely. Direct consequences. General Motors reported a 35% drop in net income, said new auto duties took a $1.1 billion bite.
Ouch. Anyone else?
Stellantis similarly impacted about $350 million. Even defense contractors RTX, Lockheed Martin, they faced lower earnings forecasts, significant special charges. They specifically cited tariffs.
So it creates a lot of volatility for earnings, for
Yeah.
supply chains. Something you need to watch closely.
Definitely. Which actually brings us nicely to our commentary segments.
Right. First question. The report notes this kind of paradox. A global economy seemingly powering through trade chaos, markets hitting records, even while tariffs hurt profits and recession odds tick up. What's enabling this resilience?
It's a great question. How can the market climb this wall of worry, as they say? Well, JP Morgan data shows global GDP growth was actually decent in the first half of 2025, around 2.4% annual rate. Pretty much its long-term trend.
2.4%. Okay, so the underlying economy isn't collapsing.
Not according to that data. Trade volumes were buoyant. Growth forecasts actually got raised across Europe and Asia.
Still seems a bit counterintuitive given the tariff impacts you just mentioned. How are businesses coping?
A key trend emerging seems to be businesses relying more on local production, reshoring, nearshoring, whatever you want to call it.
To avoid the unpredictability.
Exactly. It mitigates the trade policy risk, acts like a shock absorber. Now, some economists do warn about delayed effects, maybe like Brexit's slow burn impact.
The possibility.
Yes, but the immediate economic hit seems less severe than many feared. Maybe current market valuations already price in these worries.
Or maybe the specific tariff levels aren't high enough yet to cause major macroeconomic damage.
That's another theory. Perhaps if they stay below, say, 30% or 50%, the broader economy can absorb it, especially with corporate adaptation. It shows how adaptable companies can be and maybe how markets look forward.
Okay, let's move to the second question area. The report details challenges to the independence of key institutions. Specifically mentioned are the Federal Reserve in the U.S. and Ukraine's National Anti-Corruption Bureau, and ABU. What are the wider implications here?
This is about political pressure on bodies meant to be independent. In the U.S., you have President Trump's efforts to influence Fed Chair Powell on interest rates.
Which raises concerns about Fed independence, obviously.
Right. Now, the Supreme Court has affirmed the Fed's unique structure, its protections. Powell likely can't be easily fired just for disagreeing on rates.
But the pressure itself is significant.
It is. And the bigger concern might be future appointments. Vetting nominees based on political loyalty could risk, well, a return to the kind of inflation we saw in the 70s, when political influence arguably compromised monetary policy. Undermines credibility.
And the situation in Ukraine. Also about independence, but different context.
Yes. President Zelensky signed a law that effectively gusts the independence of MBU. This was an agency set up back in 2015, under Western pressure, mind you, to fight corruption.
So, rolling back reforms.
It looks like a concentration of power. It prompted protests, expressions of concern from G7 ambassadors. They stressed these institutions need independence to maintain public trust and support Ukraine's reform path.
And the risk.
It could jeopardize Western support that's vital for Ukraine's defense, its EU aspirations. So you see this global fragility where independent bodies face pressure from political goals. For you, the takeaway is watching how these core governance structures hold up. They impact economic stability, alliances.
Okay, final area. The report also touches on some, let's say, less conventional risks. Workforce infiltration, chasing college sports economics. Seemingly quite different, but what do they reveal?
They reveal evolving vulnerabilities, perhaps, and new financial models emerging. The workforce issue is quite startling.
What specifically?
The FBI identified thousands of North Korean IT workers. They've infiltrated the U.S. remote workforce using stolen or faked American identities.
Thousands, working remotely for U.S. companies.
Apparently so. These aren't typical workers. Described as devoted to Kim Jong-un, very skilled at stealing cryptocurrency, one reportedly stole over $62 million from a project called Munchables.
$62 million. Wow.
And oddly, obsessed with Minions from the movies. But the point is, this is a state-backed threat operating under the radar, exploiting remote work setups. A significant security and financial fraud risk many companies might not even be aware of.
A very unexpected vulnerability.
And the college sports angle, how does that fit?
It's about a fundamental economic shift. The new College Sports Commission is challenging the booster collectives.
These are the groups paying athletes for name, image, likeness, NIL deals.
Exactly. Wealthy alumni, fans, pooling money. They've apparently accounted for over 80% of the NIL market, which is estimated at maybe $1.7 billion total.
80%, so the vast majority. Yes. But the commission is now requiring a valid business purpose for these deals. This could potentially eliminate something like $1.4 billion in athlete compensation that came through these collectives.
Wiping out most of the market overnight.
Potentially. Or forcing it back underground into less transparent methods. It creates huge legal and financial uncertainty in this rapidly evolving collegiate sports economy. It shows how clarifying rules or just challenging existing practices can totally reshape a financial landscape, even in sports.
So both examples show unexpected risks and how established financial or operational models can be suddenly disrupted.
That's right. Today's deep dive really highlights these intricate links, doesn't it? Tech innovation, energy security, trade policy, institutional stability, they're all connected.
Absolutely. These intertwined global shifts, they'll keep reshaping investment landscapes, national security priorities. It demands constant vigilance, adaptable strategies from all of us. Think about it. XAI's funding, China's energy pivot, even the structure of college sports pay. How do these threads ultimately weave together to affect global stability, perhaps even your own financial reality? Something to consider. Thank you for tuning into the Wall Street Podcast.